Sana, welcome you all. Our speaker for this evening is Professor Sankarshan Basu. Professor Basu has briefly been associated with the finance industry, working in the treasury operations of ICICI Limited. He is currently a professor in the Finance and Accounting Department of IIM Bangalore. He is actively involved in various consulting projects ranging from insurance companies to various governmental services like the Indian Revenue Services and the Indian Foreign Services. He also serves on the boards of the Clearing Corporation of India Limited, Bangalore Stock Exchange Limited, and Bilcare India. We welcome you, sir. The topic for the webinar today is NPA crisis in India. Is the worst behind us? The webinar will be followed by a Q&A session. Viewers can ask their questions and relevant queries during that window. Thank you, sir.
Thank you, Anvisha. Thank you for inviting me to this to deliver this webinar. Just quickly, as a matter of half a minute background, when this was being, we were discussing this. The idea was to talk about the NBFC crisis. But the NBFC crisis in India has predominantly been created by the NPA crisis in the financial sector, the banking, and as well as the NBFC sector. And I'll show that to you as we go along, which is why I've kind of modified it a little bit. And this is kind of relevant in the current context. There's been a lot of interest around this, not just in India, but pretty much anybody who wants to invest in India, looking at India as an investment destination, and hence, from the perspective of the World Investment Week, I thought this might be an interesting thing to kind of look at. Also, let me also state the fact that towards the end, I'll talk about the fact that this is not just something which we've seen here. The exact crisis may not be replicated or may not have been replicated, may not have been a kind of a direct mirror image of something that's happened earlier, but things have happened, and people have, and other countries have seen some crises like this. Some solutions have been tried. We'll talk about why some of those, what are the implications of that, and can that be tried in India, and then some of the actions that we have. So let's start with some data, and I know we are in November, but I know the kind of data that I kind of looked at is not too far back. I looked at between the period between June to July, so 2019 July to 2020 July, and the bank loan growth has only been about 5.6%. The status, obviously, and I'm identifying that as slow. And then if you look at, I've kind of divided that also, and one of the basic reasons that has been talked about is essentially lockdown. But the whole question is lockdown the only reason, or is there some kind of other factor that has kind of come in? If you look at the same comparison, instead of the year-on-year, the one-year data, if I've kind of looked at just the March to July, so this is basically the impact of the lockdown story. You see the bank loan growth over the lockdown and intermittent unlock periods that we've seen has been only about at less than 1%, less than 1%. That's the rate of growth, 0.78%. Whereas the same thing in the previous year was about over 1.07%. And the primary rationale for this probably is the lockdown and the cautious approach. On the other hand, the demand for the interest in time and demand deposits have gone up from 3% to 5.11% for the same comparative periods. And this is primarily because people have wanted to have the liquidity, and I think there's been a preference for liquidity in the market, which has kind of created this demand. And that's kind of an environment in which we are today. So when we talk about the fact that as a crisis over and is the worst behind us, well, we have to understand that that's the context in which we are. And to kind of give you a background, obviously one of the most important aspects of the banking segment is to kind of forward or give loans and advances to borrowers. And depending on the performance of these loans, they can be categorized as a standard loan where all payments, including borrower makes regular and timely repayments, or NPAs, which are loans and advances where the borrower has stopped making payments, making interest or principal repayments for over 90 days. That's for the banking sector. Now, interestingly, the NBFC sector also comes in, and that's where the difference comes in. That's where the challenge comes in. So if you look at the NBFC sector, the definition of NPAs is kind of very similar, except that suddenly from the 90-day window that banks have, NBFCs have a flex of that over 180 days. So while if somebody doesn't pay to a bank over 90 days, it is declared as an NPA. The same person, if he or she has a loan from an NBFC, that can only be talked about in terms of 180 days or after 180 days. So there is this 90-day or 3-month difference that comes in. What we've also seen is, and the reason why we look at from the bank's perspective, just to give us an indication, and obviously, that is an overall indication in terms of how it is given, because that data is kind of more organized and therefore relatively easy to get. The NBFC data is not so well organized because while you have organized NBFCs, large NBFCs, you also have smaller players, so it's not that well organized. But what one can easily see is that in the market between 2000 over a 10-year period, and this is obviously rightly, but this is suddenly a problem that has not happened today. This has been brewing over a period of time. So in 2008, the NPAs as a percentage of total loans was only about 2.3%, which rose by about good 4 times to about 9.3% by the time of 2017. And I will show you the next slide how the growth has kind of moved. Now, what is the impact of these? This essentially means that there is a requirement for larger provisions for losses by the organizations, banks in particular, because banks also have the safety and security argument that comes in, that the central bank brings in, and that's where this argument comes. That's where this argument becomes very relevant. This obviously indicates that the amount of banks' assets that it can use to generate income reduces, and therefore, obviously, the profitability of the bank and its ability to grant future credit also kind of gets limited. For an NBFC, the story is similar, but the regulatory requirement on NBFC is much lower, if not absent, and hence, while the broad argument remains, but they don't necessarily need to kind of account for the provisions, and therefore, while they will have a little larger ability to lend out in the market, even with an NPA, but obviously at some point, if the money does not come back, and if that's the rate at which the NPA problem is growing, even the NBFCs will be exposed to a similar problem. Now, if you look at this is kind of how it is looked at, and that's what I was trying to say. So if you look at it if you look at the lowest was somewhere around 2008, 2009, where it was just above 2%. Today, it's close to about 10% or just below 10% in 2017, 9.3% as we said. Obviously, historically, 1999, 1998, it was as high as about 14, 15%. But, it's just that there's no solace to the fact, or there's no point going back in the point in time and saying, 20 years back, we were at 18 or 15%. We're today at 10% or 9%, and therefore we are better off. I think because if we make that statement, then yes, that's probably okay. But I think the biggest challenge that you actually end up seeing is that the fact that we had done much better, we had come down to about 2.5%, 3%, and instead of holding it on from there, we've managed to increase it. Part of that has also happened, external factors like global financial crisis and subsequently the current account deficit crisis and all of that has kind of impacted the story. But the fact is, it's again gone up, and that's kind of creating a whole challenge. Now, before I go into what some of the things I believe what led to the rise of NPAs, I think what's interesting to look at is this data, which is basically even for the NBFCs, and that's why the banks become a relevant question. So this is kind of taken from RBI data over a period, and this is kind of the latest RBI data that we kind of got. I mean, up to March 2020, over a 3.5 year period. The NBFC's deployment as a percentage of gross bank credit has gone up from around just about 5% to something like close to about 8.5, 8.7 to 8.83%. So there has been a significant increase of bank loans as a funding source for NBFCs. And now if the NBFCs do not, and therefore there's an interlinkage that is happening in the market, because while we see the NPAs in the banking sector rise, obviously the NPAs in the NBFC sector has also risen. And that also contributes with the inability of the NBFCs to get the money back. That also indirectly contributes to the banking sector and the challenge in the banking sector, because these also become NPAs, and therefore the stress on the banking sector also increases. As you can also see, the gross credit, bank credit has gone up. Yes, in the last period, it's kind of come down a little bit, but this is all in 1,000 crores essentially. So this has kind of come down a little bit, but obviously the indication this has kind of gone up over the same period. Now, the question is what led to what suddenly happened, or what led to this rise of NPAs in India? There are two factors according to me, and I think it's relevant to talk about both the factors. There are external factors on which we don't have much of a control, which basically is a decrease in the decrease in the global commodity prices, which obviously meant that led to slower exports, and therefore the borrowings and all of that kind of got impacted. The second, and I think that is an internal problem, is internal to the Indian banking sector in particular, and in general, and I'm extending that a little more, in general to the Indian financial sector. Now, if you actually look at it, a lot of the loans that are being classified as NPAs were actually loans that originated sometime in the 2000s, the mid 2000s. This was, remember, at a time when the economy was booming and the business outlook was very positive. This was primarily around time 2004, 2005, 6, 7, before the global financial crisis really hit that. So, basically what happened was the firms were being given loans for projects which was based on kind of their own estimation of the of future growth based on the growth at that point and performance. Obviously, when firms had access to easy finance, easy loans, the firms obviously became highly leveraged, and then which essentially implied that most of the financing was through external borrowing rather than promoter equity. However, post the global financial crisis of 2008, subsequently the problem in India, the current account deficit of the financial crisis, some kind of a crisis in India that we saw over 2011, 12, 13 period, the economic growth kind of stagnated in the country, and therefore the repayment capability of these corporations or of these borrowers significantly decreased. This basically then created what is now very commonly referred to as the India's twin balance sheet problem, which is basically where both the banking sector, the lender, and the corporate sector, the borrower, came under financial stress. So basically, there was no exit route. Both of them came under a very severe financial stress, and then that's kind of what the issue kind of started becoming. Obviously, some of the other things that also happened in that context is this whole thing that underperformance led to the inability of the borrowers to repay, which basically then led to the thing that lenders started doing what is called as evergreening, which is basically nobody wanted to have NPAs, so people borrowed more and used the fresh borrowing to repay the old borrowing, and that's effect. So all that this did was essentially pushed out the recognition of NPAs to a later date, but did not address the cause of the problem, and in fact created a larger problem. Obviously, along with that, in India, over the last few years, we've seen some very huge frauds in the financial sector that have contributed to rising NPAs. But as a proportion of the total volume of NPAs, the frauds still have, the proportion of frauds is still small. But these have been increasing with no specific resolution that we know of or that we've seen, and hence this can potentially be a problem. Now, if I look at the last data that I have, the banking sector reported a gross NPA of about close to 9,000 billion rupees, or 9 trillion, as compared to about 10,805 billion about a year and a half back. So yes, there was a reduction that happened, but still the overall numbers are extremely, extremely large. The table on the right kind of shows you that 14 banks contribute to close to about 77% of the total gross NPA of 8,968 billion. And in particular, as you can see, about 6,500 billion is owed to the industry, belong to the private sector, scheduled commercial banks, which kind of added up to about 72% of the gross NPA. Obviously, this led to capital issues and capital adequacy issues and all that, which led to kind of infusion of capital from outside the PCA. So basically, a lot of banks were brought under PCA. Subsequently, the government infused fresh capital. One of the ways was by merging certain banks, and then that led to capital infusion for them. Certain banks like Dena banks ceased to exist post the merger, and again, some banks which were already outside the PCA after capital infusion, which Bank of India. So some of them post capital infusion came out. Some of them were outside that even prior to that, and that kind of came in. But if you look at the numbers, this is what kind of is what each of these banks. And here you have both private and public sector banks coming in, because I have IDBI Bank and some of ICICI and all of them. So this SBI obviously tops the list, the top three: SBI, PNB, and IDBI. As SBI, from that in that sense, other SCBs that were all there. But if you look at the numbers, SBI is also as you look at it, SBI has also reduced from about 2,234 billion to about 1,616. So there's been about a 33% reduction in year on year from 2018 to 2019. What is the specific issue in terms of India, in terms of scheduled commercial bank? So basically, removal of banks from the prompt corrective action and the bank mergers. So there has been some revival in non-food bank credit growth over the past years. What also led to this is the restructured asset window was closed in 2013, which means the ability to defer the decision of declaring an NPA was not available any longer, and banks had to report the NPAs. So, and this also, because of the PCA thing, standard banking operations were curtailed. So what you can but what the graph at the bottom shows, and this is where the real problem is, and then the complement comes in, is that if you look at it, the NBFCs and the SCBs, the scheduled commercial bank loan growth, was kind of very similar if you go back to about 2013. The scheduled commercial bank growth has kind of seen a secular downward trend with a very little uptick towards the end and 2018 kind of period. The NBFC loan growth has seen both ups and downs relative to the SCB loan growth, but for the last about 4 or 5 years, you see the gap has been widening and then it's kind of diverging, and it's close to about 20%, whereas this has come down to below 9% or around 10%. So if you look at that, the same 7-year period for the NBFCs, which they kind of seem to therefore complement the Indian banking segment. And if you look at the loan book for the NBFCs, it increased to about 28,000 billion, 29,000 billion, about 400% over 7 years. NBFC's loan to total lending was about 26% compared to 14% 7 years back. And interestingly, about 236, which is about 2% of the NBFCs, contribute to about 86% of the total lending that NBFCs kind of do. So and that's why there's a huge number of NBFCs, some doing very small business, but you can identify about 236 of them, which kind of adds up to about as high as about close to 86% of the total lending. So therefore, the NPA crisis and the relevant crisis of the NBFCs cannot be segregated. They are kind of very closely interlinked. In fact, what the NBFCs does in India is this whole argument of what is called as a shadow bank. And what is a shadow bank? A shadow bank is basically an institution which carries out a very similar set of functions like a banking entity, yet is not really regulated under the banking laws of the country, and therefore remains below the radar in that scenario. So as I said, the share of NBFC lending has increased to about 26.6%. Sorry, I'm extremely sorry. That's a typo. It's not 263. If I follow on from the previous slide, it's 236. It's a typo that I have, which lends about 86%. But the biggest issue that comes in all of this is the NBFCs are not convergent under the regulation of RBI like SCBs. But yet they undertake the traditional functions of a bank without RBI funding facility, basically without having the cushion of the safety of having a lender of last resort in the RBI, without any kind of deposit guarantee insurance for the depositors. So but yet they undertake liquidity, maturity, and credit transformations. There has been enough work that has kind of been shown out there. So what this essentially shows is that the NBFCs act as if they're banks without the safety and the benefit and the cushion of the deposit holders guarantee or insurance that banking sectors are kind of forced to have. NBFCs also lend not just to individuals, they lend by borrowing from banks. They lend not just by borrowing from banks, as we saw, but they also borrow from mutual funds and other insurance companies, and thereby this kind of creates this joint exposure to the system, which was earlier represented in terms of the twin peak problem. So what this means is that one needs to kind of monitor the impact this joint exposure would have on the stability of the financial sector. It is not any one sector, but the joint exposure on that. In fact, that's kind of the most important thing that we kind of talk about, in not the most, but probably a very important thing from a larger context, in a larger context from the world of finance. Because as we know that the Financial Stability Board of the Bank of International Settlements and the European Systemic Risk Board basically argue and focus very heavily on the stability of the financial system compared to the stability or the survival of individual banks and financial institutions. So our focus is on systemic risk, which is exactly what is showing up out here. And that kind of creates a larger thing. Just to highlight this, you can see from this data how much, and this is kind of created from the Financial Stability Report of RBI over the years. If you look at the data kind of shows that how the proportion of exposure to NBFCs from the banks to insurance companies and AMCs, asset management companies, have increased over a period of time. And as you can see that, from around the banking sector, the overall growth has been about 3 times. The banking sector has grown about, has kind of a little more than doubled, maybe 2.5 times. The insurance companies have kind of gone again about double, or maybe a little over a double. Though there's been a dip, it went up, there's a small dip. The AMCs, the asset management companies' exposure has just skyrocketed from about 83 crores 83 billion in 2012 to about 2185 billion in 2019. So that's where the significant growth has. But all of these are interlinked, as we just said, and therefore there is an impact in if any one of them gets affected, all of them, the entire system kind of gets affected. Now, from a bank's perspective, and this is something which is very interesting and important, that what has happened to the asset quality of the NBFCs against their capital to risk-weighted assets ratio, the CRAR as it's called. So before I look, one can look at the data, but before I look at the data, post ILFS, NBFCs kind of have been being looked into the market in a differentiated manner in terms of the market access and the financial conditions, and therefore the better rated companies, in effect only the best rated companies, have essentially been able to really raise funds. There's a lot of other companies which have been adversely affected. And they've also started maintaining liquidity cover for over 2 to 3 months. If you actually look at it, the March 2020 is kind of an approximate data that I have, but if you look at it, the GNPA ratio has moved from, and then you see, so all of them have kind of worsened. Except for the CRAR, all of them have worsened. The GNPA and the gross NPA and the net NPA ratios have moved from about 4.1 and 2.5 to about 6.4 and 3.2, so which has essentially been the risk has kind of increased. As also similarly in terms of the CRAR has reduced from about 26.2 to about 19.6, indicating that the amount of capital available to protect themselves has kind of come down, and that's a challenge that kind of exists in the process. Now, this is a problem that's kind of come up, and a significant part of the problem has essentially been, if you have highlighted, see, if you look at the NBFCs, while small finance banks and all are there, but the real challenge has been with the NBFCs and in particular with the MSMEs, because as I'll show you in the next couple of slides, this whole argument of loan moratorium and all has kind of really been taken up by the MSMEs in the largest amount. But if you look at the NBFCs actually have the maximum amount of loans under moratorium under each of those schemes, and that's kind of really created the whole, has brought in the focus on the NBFCs and the challenge that it creates. Right. And this kind of shows the MSME loans, manufacturing and services. So the first one is in terms of deployment of credit, the first one is an overall MSME, then it's kind of the manufacturing and the services and manufacturing together. And as you can see in the manufacturing sector, it's kind of MSME loan ratio has come down significantly. The sum of the ratio when we take service and marketing together has kind of come down, but has been more flatter, not so sharp a decrease as in the manufacturing. So however, the good part of it is that while the moratorium on availed by MSMEs is maximum across outstanding loans, as a percentage of gross bank credit, MSME loans are still thankfully in single digits or kind of in low numbers, so it's not that much of a problem. I mean, it's still a problem, but there are there. Now, what I'm going to why am I talking about this? Because particularly in the last 2 years, the MSMEs have kind of the asset have kind of become big time in focus, because the asset classification benefit will be available only if restructuring is done under the provisions of the resolution framework. And what is the resolution framework? In 2018, RBI provided relief to MSME on account of the GST implementation. So basically, standard assets in the status in the banks and NBFCs books were subject to a certain set of conditions that RBI put out. In 2020, they provided a second set of relief, which and to classify as standard, and that could be and the same could be restructured without a downgrade in asset classification, subject to certain conditions being met. So, it should be standard as of a certain date. It doesn't exceed a small amount. It doesn't exceed 2.5 million. Restructuring of borrower account is implemented in a year's time, and then all kinds of things. And then banks, but the point is, banks, the cost was borne by the banks, because the banks had to maintain an additional provision of 5% over and above the provisions already held by them, which was obviously going to make it expensive. To top this, there were other decisions of the central bank which came in, and that created a whole challenge. Because of the crisis that we were looking at as far back as in March 2020, the Monetary Policy Committee of the Reserve Bank of India basically in their meeting announced that they were taking an accommodative stance. And the repo rate under the Liquidity Adjustment Facility, the LAF, was reduced by about 75 basis points to 4.4%. The marginal standing facility and the bank rates were also therefore reduced to about 4.65 and 5.4%. 5-year long-term repo operations were done, so kind of reduce this, at the point between March 17. So there was a kind of repo operation that also came in. There was liquidity injections that were kind of created through open market operations, through swaps. And RBI's liquidity injection at that point was about 3.2% of the GDP. And this was just in a month between the February and the March meet. The next meet in April also kind of looked at, and they kind of added systematic liquidity surplus by doing systemic net absorptions under the LAF, which averaged around 4.36 crores during a 2-week or 2.5-week period between March 27 and April 14. Remember, this was a period of the first lockdown effectively. They also did 3 targeted longer-term repos, and that to inject about 75,000 crores into the system. And subsequently on April 17, another 25,000 crores was kind of introduced. So so far this has been largely been to bonds issued by the public. These funds have been so far targeted to bonds largely issued by PSUs and large corporates. They also did a targeted long-term repo of version 2 of 50,000 crores in tranches. Then this should be they put some conditions that came in, with at least 50% of the amount availed going to small and mid-sized NBFCs and MFIs to kind of take care of them. The RBI also kind of put in more refinance facilities totaling about 50,000 crores through various other entities like the NABARD, SIDBI, and the National Housing Board. And more importantly, they introduced moratorium 1.0, what I'm calling the term as 1.0, which basically said from March 1 to May 31st of this year, there was individuals, corporates, and MSMEs could kind of take a moratorium on both on all payments, interest, principal, as well as working capital. And the working capital, obviously, only the interest. Commercial real estate projects loans were automatically given a 1-year extension. In May, they basically extended 2 things. They extended the moratorium period from May 31st to August 31st, and the refinancing facility, additional refinancing facility of 15,000 crores to SIDBI was brought in, and lending institutions were allowed to convert accumulated interest and working capital facilities over the total deferment period into a funded interest loan, so that the NPAs did not show up as NPAs. They also had the August decision, which was the last major one. After that, the MPC, the old MPC term got over, and the government for a long time didn't appoint it. They appointed an MPC the new members of the MPC very recently in October, and not much has kind of happened post that. So one of the primary things that they did was they kind of issued corporate bonds were issued to the tune of about 2 lakh crores. But what they also saw was market credit movement. The non-food credit had slowed. But on the other hand, credit to NBFCs was increasing. Loans to services went up. Credit to housing was also kind of going up because of the cheap capital that was being infused in the system. Additional special facility of about 10,000 crores would be provided at the repo rate, which was shared between the National Housing Board and NABARD. There was restructuring of MSME debt that was created, and further gold loan. The classic conditions were brought in terms of the gold loan, and the loans could not be more than about 75% of the value of the ornaments. So there was about a 25% haircut that was kind of brought in. A lot of these essentially kind of brought in liquidity to the system, but also most, as you can see from the loan, most of the liquidity also went to the NBFCs. But on the other hand, the NBFCs having the differential conditions in terms of their declaration of NPAs and all, obviously added to the systemic risk. What happened out here? So, as I said, in the NBFC sector, if you look at it, the asset under management in the NBFC sector, which kind of is there, has kind of grown up. So, what we should look at is up to about FY20, which is still an estimate, which is about approximately at 25%, at about 25%, which is about a 4 to 6% increase, about a 4 to 6% increase from the previous year. It's expected to kind of stabilize around that in the next year as well. But these include housing finance companies, but obviously exclude government-owned NBFCs, and comprises data from 8 top NBFCs that are about 75% of the market share. If I look at the specific scenarios where NBFC growth has happened, you can kind of see the asset under management growth in FY19, FY20 the expected, and FY21 the projected. This data is something which CRISIL kind of published some time back, and from there, and on the left hand on, I've taken various kinds of loans that are available under the NBFC thing, from home loans to vehicle finance to retail, MSME finance, unsecured loans, gold loans, and for each one of them, underlying asset sales, where does the bank come in? So I've kind of tried to put together, from the CRISIL data, this is actually from the CRISIL data, this is how the impact or the negative impact of the parameters influencing NBFC or AUM kind of come into the picture. So what this shows is essentially that these are things that has kind of, the NBFC has grown, yet there has been challenges, and therefore, the crisis is, it's not as if at this point to say the crisis is beyond us or behind us, but there may have been a certain slowdown in the crisis because of various other factors. But it's not, again, going back to the point I made earlier, it's not as if we have resolved the problem of the crisis. I think the issue is that we have kind of glossed over it at this point and not really resolved the problem, but even for the time being, slightly reduced it. Therefore, maybe we're being lured into a false sense of security that, okay, the problem is behind us. That can kind of be significantly questioned given all the data that we kind of have. Now, this kind of NPA-led banking crisis or NPA-led financial crisis is not something which is new in India. If you look at it, it's happened across the world, and I've taken the last 40 years kind of thing, starting from, and it obviously, again, Chile is not the first one. It's happened even earlier. But just kind of, at some point, I had to kind of lock it in. So I kind of took Chile, which is the first in this series which is talked about 40 years back, to about Argentina, to about USA in about 2007. And in each case, we actually had a characteristic problem, and each one of, people were trying to figure out ways to kind of work around that. Now, some of the approaches that have been followed generally to address this problem of so-called, in common parlance, bad loans in the banking system or in the financial system, and therefore restrict the consequences and prevent a systemic failure, has been kind of, the primary one has been through recapitalization of banks, essentially pumping in more money. The challenge out here isn't, how much, the question is, how much money do I need to put in? So do I have an objective assessment of the economic situation? How much is the bad debt and capital requirement? And who are the viable players who can kind of come into the system? And the other thing is that banks do undertake cleaning up and restructuring their balance sheets in all earnest. Now, these are challenges because obviously, even banks don't want to really do that unless they, and from what we've seen, unless being forced to doing it. So that's been a challenge. Another approach that's been talked about, and this was talked about primarily a lot in 2007-8 in US, this creation of a bad bank, which essentially meant that you bought out the bad assets using government money or public funds and created a kind of asset management company, primarily state-run or state-managed, or as I've called it, a bad bank, for resolving these bad assets. The primary issue that remains with this problem is that what is the price of the bad asset? Because if the price is too low, that would mean there would be high levels of recapitalization requirement. If the price is too high, that would mean higher allocation of public funds towards the bad loans. So this is kind of a catch-22 where you get hit on both sides. Another model that has also been tried is the government guarantees on the bank assets, where loans are shared between the government and the bank in a certain ratio. Now the problem here is like the bad bank story. Here also the question of pricing the bad assets and the guarantee in itself, which actually determines the ratio of the losses to be split, is a question. Further, there's potentially a behavioral issue or an opportunistic behavioral issue in the sense because the banks know the government will cover the loss of the banks, and therefore they really, at least to some extent, and therefore they really do not make a proper effort in trying to kind of look for revival or recovery, and therefore it kind of result in a worse off problem that I have somebody covering me, something which has happened in India because in a sense most of the public banks at least was always kind of based on the logic or believed in this thing that okay, however bad I am, as long as there's no corruption, I will not be personally liable, and the government will in any case bail the bank out. And that kind of leads to inefficiency in the system. It may not be illegal, but it leads to inefficiency in the system. I also want to highlight some of the crises that India's problem is not so common with what has been seen across the world. So in India, except unlike most of the other countries, India is very similar to Norway in that sense. But apart from that, in all the other countries, what we saw is when such crisis happened, the economy kind of crashed. Whereas in India, the economy has still been growing. It's yes, in the last few lockdown, the economy has gone down, the crashed. I agree. But again, if you compare it to other segments and all of that, prior to that and that period, I think there's a specific scenario on a comparative basis. There has been some kind of growth, and definitely over the period when the crisis built up, there's been one of the fastest growing economies that we kind of knew of. The peak NPL ratio in India, the non-performing loan ratio in India was about 12.3%, which was still lower than what we saw in most other countries. However, having said that, this is still fairly large, and therefore we should not be complacent that it's lower than other countries, so we don't really have to kind of worry about it. Another thing that has happened is that most countries which had experienced this kind of a crisis had a currency peg to the dollar, or typically had a currency peg. India's currency is partially convertible and it is not pegged in any other countries. Right. And therefore that's kind of another difference that happens. Internationally, most of the NPAs were in the private sector banks, whereas in India, most of it is in public sector banks. Now, one could argue that for majority of the countries, there was no question of a private sector bank. I take that point, but essentially it was privately managed, whereas in India, the management and the running of the banks may also be an issue where the NPAs kind of came in. While we've seen political changes in India over the last 7-10 years, from at least, but relative to countries like Mexico and all, there is fair amount of political stability in the country. Whereas in countries like Mexico, there was high levels of political uncertainty when all of this happened because the presidential candidate was assassinated and all of that. What we've also seen in India is our loan to GDP ratio is actually fairly low for a system compared to other countries that witness similar NPA challenges. We believe, or the government believes, that while we still have a fiscal deficit, the fiscal deficit is not burgeoning and not blowing up like a Zimbabwe-like scenario. It's still kind of fairly under control. What this therefore tells us is, and something that we started off with, that the bad loan issue or the lack of or this NBFC crisis issue in India is not just linked to one single problem, but kind of originates through various factors. Obviously, export driven because but textiles and food processing and some of these have got affected. It is linked to global commodity prices which have softened and therefore linked to global commodities of base materials. There has been a huge amount of asset overvaluation that we had seen in the mid 2000s, 2005, 6, 7 period, which has come back to hit the system now. And there are systemic issues like infrastructure, power, mining, telecom, and all of these have had huge court cases and all that we all know of. And therefore, to that extent, these have all been drivers of that. And then to that extent, therefore, to argue that can we simply blindly replicate the international experience? The answer is no, because while there is the problem seems to be similar, the causes of the problem is different, and therefore we cannot really, while there are relevant international experiences, we cannot really replicate a solution that has been tried elsewhere, just because our basic framework and basic arguments are kind of different. As I said, the two relevant is the closest experience is Norway, because during or after the crisis, it did not see a major dip in the economy. And the other one was Korea, because lending decisions in Korea were also closely linked to the government decisions of promoting large clusters, large entities in chaebols in Korea. In India, similar to Korea, large infrastructure projects have primarily been financed by the public sector banks for promoting growth of infrastructure in the country. And it is not always necessarily have been a commercial decision. So therefore, there are similarities that we can kind of look up from a Norway or a Korea example, but not otherwise. Has the government been sitting back and doing nothing? Well, no, they have kind of tried to follow what is called as a 4R strategy. They've tried to look at first, recognize, which will be the first thing, which is why we are talking about the problem. Then they're looking at a resolution mechanism. Can it be resolved or cannot be solved at that level? Finally, if that doesn't happen, then they've kind of tried to go for recapitalization as and where necessary and needed. Because after all, the system is too big to fail. You cannot let the system fail, particularly in a country like India, where the financial system and the banking system closely replicate the social security system in the country. With an absence of a formal social security system, the financial system is therefore the de facto social security system. So collapse of the financial system is more about collapse of the financial system, but collapse of the social security system in the country, which could have other disastrous economic and other consequences. And finally, they've also gone on some kind of a reform model, though this is where I think much more could be done, and this is where it's kind of the gap is still there, and there has been different people who've debated this threadbare, saying is the reforms what we've done, has they been good enough or not? That's been talked about. Some specific things. The IBC was brought in. The Surface Act was and the Banking Act has been amended to make it more effective. New DRTs have been established to expedite recovery. Stressed asset management verticals for large loans over 250 crores by the PSBs under the PSB reform agenda. And across the board, better credit risk management and corporate governance processes at the bank level. And this has been now mandated by having people with certain certifications and all of that come in. So today, to be a chief risk officer of a bank, you need to be either a GARP or a premier certified risk officer or a chartered accountant. So, in the last year, about 2 years, they've kind of made certain very specific things. So a lot of those processes have been kind of tried to be put in place. Some solutions that have been tried, but has not really kind of worked per se as yet, because there was a talk of setting up a bad bank in India with the government involvement, but that's not really taken off. There have been talks about establishment of a professional asset rehabilitation agency. That's something which also has been talked about, but not really taken off significantly. I think the biggest thing is that this should be this has not really been taken to its logical conclusion, which is there's lack of an environment, particularly for the PSBs, to take a significant hit to make bad assets attractive for asset management or reconstruction. Primarily because these banks have no incentive for doing this. On the contrary, there's a huge disadvantage because this could kind of writing this off could kind of lead to frivolous charges genuine or frivolous, I don't know at this point, that it was done with ulterior motive and therefore it could kind of come under the scanner of the investigative agencies. Nobody really wants to kind of get into that when you can get away by not doing anything. So so that environment doesn't exist. Plus, most of the bad debts are concentrated in books of large firms. So it's politically a huge challenge, because if you write this off, it could be kind of, the parallels or linkages could be drawn in terms of certain favoritism that the government or the agencies are kind of engaging in, and there are political implications. And the government definitely does not want to be seen to bail out a few industrialists, because that has other implications, as we talked about. One could provide fiscal resources to capitalize both the asset management companies and the PSBs. This has been tried in a limited way, as we said, to recapitalization, but it's always a challenge, and in current times, it's going to be an even bigger challenge given the difficult fiscal constraints. And then, if you are going to take out a significant amount of this revenue, it will impact the government's capital expenditure, which will obviously have an impact on government spending as well as in other sectors, and the economy could get impacted otherwise. Particularly because also the private sector investment is not really gone up or not really picked up to the level that one would expect, and that continues to remain weak. Also, probably, that's been talked about, but again, it's very difficult to politically implement this. The government should actually exit from the bank ownership, but there are other challenges. One of the reasons that I'm suggestion that it should exit is because government ownership does not allow the banks to kind of write off bad debt. Like a normal company, okay, something's gone, let's write it off, let's raise fresh capital, move on. As it will hit the taxpayer, as the hit will have to in the government banks, the hit will be the taxpayers and not the set of shareholders, as the case of private business, and therefore that can have its own implications. Very quickly, just to finish it off, and I just want to kind of wind up with the last two statements. So there are three main success stories that we have seen. I know I'm overshooting, but just 1 minute more. In Sweden, in Korea, and in USA, there are three main success stories. But if you look at the Sweden story, it's been very, very clear that there was huge amount of political unity. And then there's a specific comment from the European Commission. Political unity, and I quote, political unity is the passage through Parliament of measures to support the financial system. In addition, representatives of the opposition had full insight into the resolution process, thus maintaining political accord. Political unity was necessary in terms of adopting a swift, decisive, and lasting approach, unquote. And that's something which is very difficult to kind of, if you think of in India, if you think of even today's USA, it's very difficult to kind of think about such a scenario happening. But that is probably one of the drivers. If we could kind of get there, yes, it would be much easier to resolve some of these issues. In Korea, South Korea, the Korea Asset Management Company was kind of successful in resolving the bad debt crisis after the Asian financial crisis, and that kind of a model has been what's been talked about. In the US, it's been the TARP, or the Troubled Asset Relief Program, which has earned positive returns to the government. But again, the whole point is, does the government have the money to kind of put it in? The US, they seem to have, at that point, they had it, which they put it in. For us, do we really have the money to kind of create a TARP? And I think that's where the real challenge is. Finally, some key observations, and as you can see, the last point, the NBFC crisis, NPA crisis is not going to go away at any point. What has happened, what we know from the moratorium 1.0 and 2.0 is though there has been some pickup in collections from June, a significant number of the NBFCs continue to remain in moratorium. And therefore, they're kind of deferring their problem. They're not really solving the problem in any coherent, any clear manner, hoping that the external conditions will change and therefore they would automatically come out of the crisis. Good luck to them, but chances are not very high. Well, there has been a reduction, as I said, down from 65% to about 45%, but still, it is quite large, and all of that. MSMEs are the largest moratorium availers as we have. What we've seen is NBFC growths have been stunted because of their inability to lend and no money, and their dependency has kind of increased from an overall exposure from 190 basis points from about 8.8% to about 8.8% from about 6.9% between September 18 and June 2020. So in a 2-year span, it's gone up by about 200, close to 190 basis points. In absolute terms, the bank's outstanding banks outstanding to NBFCs saw a huge, about a 47% growth from 7.99 lakh crores in 2020 to 7.99 lakh crores in June 2020 from 5.47 lakh crores in September 2018. So again, over that period, that actually, while the exposure went up by about 190 basis points, it may not look that large, but in real terms, it actually went up by about a hopping 47.1%, or about 8 lakh crores, and this is 5.5. So 2.5 lakh crores approximately is what it went up by. Given all of this, at the end, I'd like to simply end by saying, what's the likelihood that what's going to happen with the NPA? It's likely to increase. It's not likely to kind of get over very soon, because again, we are not really addressing the root cause of the problem. We are trying to defer the problem to a later date and hoping that something else will happen and miraculously we will be saved. And that will obviously keep on impacting investors as we go along, because investors will obviously have to bear the brunt of all of this. Okay, thank you. Let me stop with that and then obviously open it up for any questions, comments anybody has.
The question Q&A window is open.
Yeah.
Y'all could ask the
necessary. We have about 5 minutes or so to do a couple of Q&A. Yeah, Anil. I think Anil's raised a hand. So
I am sir from Nifty Mumbai. I'm also doing some work in this so NBFCs and shadow banking. So can you tell me some of the research objectives I can frame or something if I want to study some phenomena in Indian context?
So there's not been much work on the Indian context in terms of the shadow banking story. I think, but one of the seminal works has been by Viral Acharya. I think in 2013 and in 2004, 2007. I think there is a paper in 2013-14, and then there is, I can't remember the exact reference, but it's 13 or 14, and then there is a paper by Viral again in 2017, where they talk about shadow banking and the impact of shadow banking in India. There's been a lot of work in shadow banking that's happened, particularly with China in focus. So one could kind of use that as a framework. We also did a detailed analysis and a study of a lot of this a little earlier, so the data would be a little dated, but you can kind of look at that with the Indian Institute of Banking Finance, and we submitted a research project where we submitted a detailed report to them. So I think that's where you can kind of get some more data. But I think the biggest challenge in all of this is, and we are working on some other things, which is essentially this whole kind of the interlinkage that exists between the NBFCs and then the borrowings from the corporates and the kind of resources that they're using to as a pledge to borrow capital, and what happens to this pledged assets, primarily shares and all of that, and how does that kind of impact the liquidity and the sustainability and the survivability of the NBFC in question.
Hello.
Hello.
Sir, this IFA conference will be happening.
Hello.
Hi, Badri.
Hi.
Yeah. Yeah, Anil, you were asking something?
Yes, so this IFA conference will be happening next year, or
Yes,
this
yes.
year is postponed?
No, this year is postponed because of the pandemic.
Okay, okay.
So Mr. Badri has a question.
Yeah, please, Badri, go ahead.
No, no, no. Sorry, it was by mistake.
Oh, okay.
Okay.
We will not be able to take any other questions, but it was a wonderful webinar, a very well explained webinar. Thank you so much for spending time with us.
Thank you, Anvisha. Thank you.
Thank you, sir. Please end the meeting.
Switch off my
The
video now.
IT, yes, sir. IT desk, yeah, thanks. IT desk.